Hello and welcome. So today we will explore how you can start your investment journey even with a modest salary. So for example, even if you are getting a salary of let's say 10,000 or even 15,000, how you can invest this and you can make a long-term wealth. Okay. So we will discuss four key investment strategies. We'll start with the safe options, which you can start with as your salary is less, and then we can also discuss the medium risk option, and I can also discuss about the high risk options where you can deploy, you can take some risk so that you can retire early if it work out. And then also I'll discuss what I consider as the best option and the best approach for long-term wealth accumulation. So let's let's start with the session. So let's start with the first one, which is the safest one, and that is nothing but the fixed deposits, right? See, FDs are favored by many because they offer a guaranteed return and generally around 6 to 7%. Only thing is that there is issue with liquidity, right? But return is normal. You get normal return, you get safety. But what is compromised here is liquidity. So what we are looking for when it comes to investment is three things: safety, and then growth, the return, and also liquidity. So when it comes to fixed deposits, it satisfies two criteria. That is safety, right? You get at most safety and decent return, which may beat inflation, okay, but not liquid. So there are other instruments also, right? When we talk about stocks and all stocks, it is liquid. You can sell any point of time. High risk, high return. So issues high risk. Same with the mutual funds, right? But this is what we see in the fixed deposit case. And if you talk about real estate, it is illiquid. You cannot sell at any point of time, but safe because it's a tangible and it will anyway grow, and you'll get return also. So there may be some issue with something if you go for stock. Risk is there, return is high, it is having liquidity. Fixed deposit, there is issue with liquidity, but return is modest, but it is safe. Real estate, it is safe and return is also there, but it is not liquid. So taking into consideration all these, will be discussing all the four types. See, if you choose to invest 30% of your salary, suppose you getting 10,000 and 30% means 3,000 per month in an FD. Now, it is very crucial to understand what kind of wealth this can build, over a period of time. By consistently saving and investing in FDs, you can accumulate a corpus, but due to inflation, the real value of this sum may be significantly less over the years. Sometimes inflation may be, so let's say 8%, and if you're getting 6%, it is negative 2%, out of which you need to pay tax also. So this is something which has nominal interest rate. There is something called as the real interest rate. Real interest rate must be adjusted with inflation. So if you see the real interest rate, if FD is giving you 6% minus inflation, let's say if it is 7%, then what you get? -1. So the real interest rate is negative there. Okay, so you need to have a return where you get something more than the inflation. Let's say you get a return of 10% and inflation is 8%. So what is the effective return? 8%. Sorry, 2%. 10 minus 2, that is 2%. That is a real return or real rate of interest. Anyway, we will discuss more onto that later. Now, this is what I'm talking about. Inflation may eat all these. So this method is risk-free, but the returns may not be high, okay, or that may not be enough for long-term wealth building. I don't think that it can build wealth for you. Okay, so it may go like that. You keep on investing. That's what it may not build wealth for you. Now, coming to the next one, that is the medium risk option. That's nothing but the mutual funds and also the stock market. See, the next step from FD is actually investing in mutual funds, especially index mutual funds. So unlike trading, which requires in-depth market knowledge, investing in mutual funds allow you to benefit from the expertise of fund managers. So there are people who are going to manage your fund. And you can invest passively in funds such as Nifty 50 index funds, mid-cap index funds, and small-cap index funds. These funds offer, diversified exposure to the market and are managed by professionals who decide when and how much to invest in different stocks. So over time, mutual funds tend to provide better returns compared to FD and comparatively more safe because it is managed by the professionals, but again, subject to market conditions and market fluctuations, market volatility, and market risk. Now, coming to the next slide, the different types of index funds, let's try to understand. See, again, to diversify further, consider the three main types of index mutual funds. You can go for Nifty 50, mid cap, and small cap index funds, right? So, Nifty 50 index fund invest in the top 50 companies listed on the stock exchange. So, always the top 50 companies will come over there. So, if there is any company which goes to 50 first, then what will happen? That company will be replaced with another one in the top 50. So, chances of this going down is very less, and that's why I said it is safe. Only if the country goes down, then this will goes down, right? So this is what top 50 companies, and that offers stability, also very low risk. So mid cap fund invest in medium sized companies which can offer high returns, which we discussed already in the previous session, but can come with somewhat greater volatility compared to the previous. It can keep moving, right? It can be volatile. On the other hand, smaller cap fund focus on very small companies. The potential for growth is so high, you may become very rich soon also if things work for you, providing the potential for highest return, but with the most significant risk also involved here. It's not that stable as the companies like Reliance or TCS, right? So here the potential for risk is there, potential for growth is there, and each type has its own risk and return profile, and making it important to balance your investment according to your risk tolerance. So that's why we discussed about how you are going to diversify your portfolio. That is something which is very important. Let's also try to understand the long-term benefit of mutual funds. If you see Nifty 50, it's around 10.5%. So even if you see adjust with inflation, it's giving a better return. Mid cap, you see 14% risk is there, but 14% small cap, you can see the return that you're getting over there. So if you consistently invest a portion of your salary in these index funds, the potential for long-term returns is high. Over the past decade, Nifty 50 has delivered an average return of approximately 10.5%, and mid cap is around 14-15%, and the small cap is around 18 to 20%. So these figures demonstrate the progressive returns. It's essential to remember that higher returns come with higher risk. Okay, so the advantage of this approach is that with time and patience, you can significantly grow your investment without the need for extensive market research or market expertise, because there are experts who are going to take care of your fund. You're paying some small fees for that. So that too from the return that you're getting. Anyway, that is not much. Now, high risk options. Okay. Now, see, for those who are willing to take higher risk for potentially greater return, focusing more on small cap index funds might be appealing. And allocating a higher percentage of your investment to small cap funds can yield impressive returns. But it comes with uncertainty of market fluctuations. You will see huge volatility. And if you have the heart to take that, then you can do that. So this strategy is suitable for young investors who have time on their side to recover the potential market downturns, and they can hold also for a long time. But as you age, when you get older, it's wise to adjust this mix. That means you are going to diversify to include more stable investment into your portfolio. Okay, so now coming to the power of compounding, right? So this is the most important point that I want to discuss. Irrespective of or regardless of the strategy you choose, the key to maximize return is allowing your investment to compound over time. Compounding helps grow your money exponentially, and especially if you start early and stay consistent. For example, with a disciplined investment in a diversified portfolio, you could see significant difference in your corpus over 20 to 30 or even 40 years. The earlier you start, the more time compounding has to work its magic. You give more time to the market, the compounding rules will work in favor of you for more and more advantage. So start early, start now, start today. If you have not started yesterday, now today is the best time to start, irrespective of what strategy that you're going to do. Investment should be there. Whether you trade or not, that's secondary. That's your second question. But investment must be there. It should be done. Now, let's compare some strategies. See, this is an illustration which you can see. Let's compare the three investment strategies after 10, 20, 30, 40 years. See, a safe investment like FD may give you 10 to 15 lakhs over a decade, but struggle to keep pace with inflation. The inflation will go more. So after 10 years, the 10 lakh rupee now may worth 2 lakh only. right? So you get 15 lakh, it may worth 4 lakh or 5 lakh, but now you have 10 lakhs. So that's how you need to take it and understand it. A medium risk portfolio with index funds could result in significantly higher returns, such as, it can reach up to 1 crore after 30 years. And meanwhile, if you see an aggressive strategy focusing on small cap funds, it could potentially grow up to 40 crores over this 30, 40 years. And that shows the power of risk and also the long-term discipline. So now coming to investing in personal growth, that's something which you can do, right? Anyway, these beyond these financial investments, one of the most effective investment that you can make is on yourself. Spend some fraction of your earning for developing your knowledge and understanding. Spend time and money on learning new skills. Try to learn one skill every year, acquire knowledge, gain experience, and that can enhance your earning potential. Like, you can take online courses, read the books, and attending workshops are great ways to increase your value. So the returns on this self investment often surpass all the traditional investments because they directly impact your ability to grow your income and achieve financial independence and more discipline. So, guys, what I want to tell you in conclusion is, yeah, starting with a salary as modest as 10,000, still you can start and still you can set yourself on a path of financial growth by choosing the right investment strategy. I've discussed different types of strategy. You can follow any one of that or a mix of that, diversify that. Whether you opt for low risk or medium risk or high risk approach, the most important factor is consistency over a period of time, discipline over a period of time, and start now. If you missed yesterday, start today and start now. Start at this moment and start as early as possible. That's the rule of the game. Compounding is the rule of the game. As you grow, remember that investing in yourself is invaluable. That's something again which you need to do and can lead to exponential personal and financial growth. When you grow personally, you'll go financially also. So, guys, that's it for today's session, and thank you so much for attending the session. See you in the next video. In case if you have any questions or doubts, you can get in touch with me. See you guys.